Hey everybody, this is Divya again at SumZero. We're here with Ben Axler from Spruce Point, um, talking about Nuvei Corp, which interestingly Ben posted on SumZero yesterday, and the stock's now down over 40%. This will be an interesting one. Lots of history on this stock. Ben, we last talked about another Canadian sort of tech company that in your mind was grossly overvalued. How did Nuvei Corp hit your radar this time around?
Yeah, thanks, Divya. That's a great question. So as you pointed out, we put a critical short sell opinion out on Lightspeed Commerce. That stock is down about 60%. We started researching the Canadian technology payment solutions industry, and lo and behold, Nuvei came on our radar actually on Yahoo Finance as we're looking there. It says, what other companies that people that follow Lightspeed, what else do they follow? And the number one other stock that they followed was Nuvei. And I said, well, Nuvei, that's a name I don't know. And looked at the market cap at the time, over $15 billion, and said, wow, that's a pretty large market cap company for a company I've never heard of. And so that, piqued our interest. We started to dig in, do some research, spent, over a few months looking at Nuvei, and here we are today with a strong sell opinion and a critical 100-page deck on why investors should also be short Nuvei. And there's a lot of parallels between the two. I mean, both are Canadian supported technology roll-ups, highly promoted, highly supported by the Canadian sell-side banks, both with a long history. I mean, with Lightspeed, we pointed out it was founded over 15 years ago with no evidence of ever having made a profit. And, with Nuvei, you look at the founder and look at his prior businesses in the payment solution space, it, goes back all the way to the early 2000s. And
Yeah,
so a lot of parallels there.
I think like one of the most interesting things about Nuvei is just the history of the management team. So let's talk about the founder, just to start off with.
Sure. So, Nuvei, prior to that, Pivotal Payments, prior to that, Pay Systems, founded by Phil Fayer, an entrepreneur. As we always start with the management team when we're looking at companies, and that usually what piques our interest. But what caught our attention initially as we used the Wayback Machine, a favorite tool of ours, to look at the biography of Mr. Fayer. We saw that he had claimed to have graduated from Concordia University. And then, as we read through various iterations, the Canadian press found out, years later that he never completed his education there. So that clearly piqued our interest. There was also some references to him having gone to school in Florida. So we did some local checks there and found a criminal arrest record and a traffic case. And so that got us even more interested. And Mr. Fayer's initial business pay systems collapsed. The discussion there is that there was some legal change that caused the business to become insolvent and left a lot of merchants on the hook without receiving their funds. A lot of these aggrieved merchants put out websites very displeased with Mr. Fayer and the company. And, that history is not part of the current, obviously, narrative for obvious reasons. Nowhere on the Nuvei website or his biography does he link himself to Pay Systems. It's more about Pivotal Payments. But even as you progress through the history of Pivotal Payments, there are aggrieved merchants talking about, shady practices. Even, the Canadian news service had found evidence of aggressive sales practices at Pivotal Payments. So, and then today, Nuvei, there's even more references to the same old shady practices. So we see a pattern here of aggressive business practices under the leadership of Phil Fayer, no matter whether it's Pay Systems, Pivotal, or Nuvei.
So what exactly does the company do when they say, payment solutions? But what do they? Is this like a Square? Is this something like what do they do?
Well, they, help clients, and, their clients could be small business merchants. It could be, e-commerce companies. It could be airlines. It could be anything, process payments, serve their customers globally, so that if you're, a large multinational and processing payments, multi-currencies, accepting multiple forms of payments, they sort of like help them navigate that whole solution set with one platform. That would be their claim, right? And that they're global, and that they can help facilitate all these different payment types. Now, part of our concern with Nuvei, and even more so than Lightspeed, is the transparency here in terms of where these payments are actually coming from. I mean, they still disclose that they have high concentration of small and medium-sized business clients that they serve, but they won't tell you how much of the revenue is small business versus enterprise. Furthermore, they disclose that clearly they're getting some payments from traditional debit card payments or credit card payments or whatever the case might be. Well, how much percentage of revenue is tied to to a card versus a digital payment? You're not getting that sort of disclosure, nor are you getting revenue disclosures in terms of the currency impact to their revenue. Obviously, they're processing payments and have clients globally. So how much is FX impacting the revenues? There's just not a lot of disclosure here. The other part is they talk about high growth verticals that they serve, right? So how much revenue is coming from each of these high growth verticals? You won't find an answer to that, and that's part of our concern. We like to invest. Spruce Point would love to invest in high quality management teams with a stellar track record of creating value that are open and transparent. And here we find the opposite. We find a management team, with a history of value destruction, and not giving a lot of information. And so those are the type of companies we key in when we put out short reports.
Why would somebody use them versus, say, Stripe?
That's not very clear to us. I mean, what's clear is that through our research, we find and we believe that they've been experiencing negative organic growth in North America. I think that is very clear. We found some old press about the company, 10 years ago doing $150 million of revenue in North America, and then in their IPO prospectus in 2018, 150 million of revenue. So not a lot of growth. We talked to former executives and people knowledgeable with the business, and they candidly admit, yeah, the solution set is not that differentiated in North America. And so that is what we believe was the catalyst for them to move to Europe. And they brought in new private capital. They did a couple acquisitions in Europe, one being SafeCharge, which was a public company, on the London AIM, which we could have financials and we could evaluate that business. And then another large deal they did was Smart to Pay in the Netherlands. And now all of a sudden, we pointed out their margins are going up dramatically. We have questions about that, but yeah, in terms of the solution set, I mean, look, they would claim obviously that they have a great proprietary stack of solutions and that they're the favorite choice, but in reality, like they're in competitive markets. There are different solution sets being sold by other competitors, obviously. And at the end of the day, we also believe through our research and talking to former employees that a lot of their processes are manual and a lot of their technology, and they don't disclose how much are they spending on R&D, for example, and they don't disclose any patents that we could find. Now they're claiming actually recently that they're pulling forward investment from 2022, and they hired a new CTO and a new chief marketing officer. To us, this is sort of validation that this company is a little bit one or two step behind the competition, and also why we think future financial performance is not going to be as good as it was in the past, because they were clearly delaying some spending and perhaps falling a little bit behind the peer set.
Got it. Let's talk about some of the other C-suite folks or other senior managers. You mentioned your write-up, sort of a checkered past for Alan Lacoste, who's their EVP of North American Partnerships, and David Schwartz, who's their CFO, as well as a guy named Neil Erlick,
right,
Corporate Development Officer. What did you find out about these guys?
Yeah, so I mean, the consistent pattern here, obviously, we don't just look at the CEO, but we want to know, well, who's controlling the numbers? Who's the finance guy? Who's the CFO? Who's the chief accounting officer? In the case here, Mr. Schwartz is the CFO, and we obviously did a background check on him, and he had been the CFO of public company a long time ago in the Canadian markets that went through a couple iterations, but basically ended up, kind of running a business that facilitated, payments for online gambling. And that company was underneath another Canadian company called Optimal Group, which ultimately spun out a portion of their business on the London Stock Exchange called Fire One Group. And that company ended up collapsing. There was some changes of laws in terms of internet gambling in the US. They were facilitating payments in the US, and that company ended up settling with the Department of Justice and disgorging over $19 million of proceeds, criminal proceeds, they claim, tied to facilitating US gambling transactions. And so clearly that was not put on his biography for obvious reasons. And in addition, he worked with Neil Erlick, who's their corporate development officer. Both of these guys came from Fire One Group, and Mr. Erlick came from PaySafe, which is another company that's experiencing its own public challenges at the moment. And then in addition, we link the Fire One Group. The chairman of SafeCharge was also involved with Fire One Group, and that's the European business that Nuvei ultimately acquired, which again we pointed out we believe was struggling and experienced miraculous margin improvement immediately after Nuvei acquired it. And so you see a web of people here of interrelationships tied to particularly one entity that collapsed, that came under DOJ scrutiny, and these people are still involved or have been involved with Nuvei.
Got it. Just from a pure valuation standpoint, how do you view this, or what's your take on where this company should trade versus where it's trading now?
Yeah, I mean, look, it trades at a valuation that we think is disconnected from the quality of the management team, from the underlying assets, and from the prospects, from the growth prospects. I mean, it's very clear that out of the box, the company, once it came public, experienced a very dramatic improvement in cash flow and growth, and some of it we think was being temporarily enhanced. They did have, so the SafeCharge asset that they bought in Europe gave them exposure to European gaming industry. And that's a very different fit from the Nuvei's historical focus, which was, small business retail. Okay. And, we interviewed people that were there, at the time of the acquisition, and former people with SafeCharge. And what we came away with was it was definitely not a natural fit, right? I mean, you take a company with one culture serving one market and a company with a different culture serving another market, and it wasn't necessarily the perfect match. And our belief was that the expectations were too high and it took longer than expected to integrate. But certainly that gave Nuvei some cash flow. I mean, SafeCharge did have some cash flow. They did have exposure to European gaming markets. Obviously during COVID, during COVID, a lot of people stayed home and they gambled more and played the whole stay home effect. They got a good boost there, but that's not necessarily a sustaining boost. And so the growth prospects, we think some of the best growth prospects recently that drove the stock are behind it. We pointed out obviously that they brought in a new CTO, a new chief marketing officer. They're starting to make financial revisions already to 2020 numbers. They put in a new risk factor, which we found very enlightening, that they're now admitting that they didn't really do independent due diligence on numbers that some of their target companies showed them. I mean, that is a kind of big red flag there. And then they're also now changing, they've made a couple modifications to a key slide in their investor deck that talks about their high growth verticals, and they've retracted now the TAM for each vertical, and they retracted the CAGR expectations for each of these verticals. So there's subtle signs here that, if you were modeling in 30% plus growth, or, I think at one point they said their volumes were up over 100%. If you're like modeling that historically, we think going forward that those growth rates, are going to come down. And so a lot of, the valuation, and this isn't just Nuvei, but in the market, is based on, sales. And when people see a a sales expectation of 30%, and then they ascribe a much higher multiple. But let's also not forget that a lot of the sales here is acquired, right? And as we've done in our report, not just with the European acquisitions, but some of the smaller acquisitions, these we think are very low quality assets that they bought from people, with speculative checkered backgrounds. And most of these businesses were acquired, for 5.5 times revenues. And, Nuvei, at least as of recently, was trading at a 15 times revenue. Even today, it's still trading at 9 times revenues, which we think is quite high. And so, that's how we think about the valuation. We think the valuation at the end of the day, we believe should trade at a discount to market to reflect, the quality of the management, the quality of the assets. I mean, if this thing traded at a 5 times multiple, which is kind of the sum of the parts of its acquisitions, I mean, you could still see another 30% downside from here.
Got it. What is the profitability, margin profile of the business look like? Do you have any idea?
Yeah, sure. I mean, they report 80% gross margins, which are pretty high relative to other peers in the space. And we're not sure exactly, they're mixing some gross revenue and net revenue recognition things going on there. It's really hard to unravel. The EBITDA margins are reported at 43%. If you look at industry peers, it's probably a little bit higher. But there's some, again, unusual things going on that we can't quite explain with their two largest acquisitions. We did a pretty deep dive into Smart to Pay, which was this Netherlands-based platform that they bought. Fortunately, now in Netherlands, you can get financial statements. We clearly show that business was in decline. The margins were going down. We also found some evidence that maybe there was a prior relationship between these two entities. Why? Because, using the Wayback Machine, we found that Smart to Pay was already marketing itself as a Nuvei company even before they signed a deal to acquire it. So something unusual going on there. And then, you look at the margin profile of Smart to Pay, and then, they acquired the business, and then now all of a sudden the margins go up like 2,000 basis points in the quarter after they acquired the business, and then the revenue goes down organically. There's something unusual there, and we've called on management to explain. Again, getting back to our issues here, the transparency is not very high. The disclosures, the MD&A, in terms of disclosures of what's driving things exactly, is just not there. And then also, and this was with SafeCharge, which was their largest acquisition. Typically, when you do a material acquisition, you give revenue contributions for that asset over the course of a year. I mean, they didn't give you that. It's like they gave you a stub period of 6 months. It contributed this revenue, and then they don't give you, and then they convolute things. So, we don't necessarily trust the margins because of the lack of transparency here, but the margin profile appears, on the surface, if you believe management's reporting, appears to be a little bit better than your typical fintech payment company. That, and with the growth rate, was probably explaining, why the valuation was so high.
The interesting thing is, it seems like a lot of the companies they've acquired, the management teams that they've acquired, have had litigious histories. And the other one that you mentioned is called Vantage Payments. Can you talk about that?
Yeah, I mean, Vantage Payments is a head scratcher, right? I mean, it's a small acquisition, but you ask yourself, why are they buying a company like this? What real edge does Vantage have? Looking at obviously the founder and the managing partner, both individuals have been referenced in legal cases as having been tied to Ponzi schemes. And then you do a little bit more work on Vantage, and you see that they were known in the adult film industry. And the company talks about its expertise in serving hard to place or high risk industries. Well, that's one I would definitely probably call high risk, because a lot of individuals that traffic on these adult websites, they might put it on a credit card and then find out, the wife finds out, oh, wait a sec, what is this charge for this web? And then they cancel it. And then when things get canceled on credit cards, companies like Nuvei are on the hook, what's known as a chargeback, right? So, yeah, I mean, we obviously pointed out, and we, through our research, we interviewed a former person knowledgeable with their risk management practices, said that, yeah, they have they had a small portfolio of adult film clients. And naturally, in this world we live in of ESG, or talk of being a good ESG investor, that social aspect of maybe supporting a company that does business with the adult film industry could be unpalatable to some larger institutional investors.
Yeah, yeah, yeah. Yeah, I'm just always amazed by like the markets today and their willingness to kind of pay massive multiples for companies that market themselves as high growth. And it's almost like the smaller they are and the less traction they have, the higher the multiple is.
Yeah.
I
Yeah.
think it's a sign of the time.
I mean, and on the topic of valuation and margins and financial performance, I mean, one theme that we got from talking to former employees is that they clearly did target some of these higher risk industries like online gambling, or whether it be adult film or whatnot, and higher risk equals higher margin, right? But you know these are kind of smaller niche industries. There's only so many big players in online European gaming that you can have as clients. And part of what we learned about the safe charge is that they were kind of a victim of their own success. I mean, they grew into that market, but then once you're in that market and you're there, like how much more can you grow with it? And so, part of the challenge we think that lies ahead for Nuvei is that it now is going to have to compete in more of the mundane markets, the lower risk markets, which, by the way, lower risk markets equal lower risk, lower margin, right? So that's another reason we believe that the financial performance historically is not going to be matched by what's happening in the future, as they have to compete in the lower risk, lower margin markets.
What would you say are the catalysts in the next 6 months for the business outside of earnings? Anything in particular?
Yeah. No, it's hard to pinpoint a specific catalyst. I mean, other than macro factors which affect payment processing companies, velocity of payments, consumer retrenching from Omicron. I mean, look, I would love to see, with all of our reports, I would love to see an independent investigation of our work. I would love to see the board hire an independent investigator to evaluate why the margins went up so dramatically in the targets. And I would love to see more disclosures, obviously, or some, there could be a financial restatement. As we pointed out, we're seeing subtle signs in the financials of revenue being revised, but not just revenue, and it's small amounts, but also we found revisions in the cash flow statement and the financing statement too. I mean, if you start to see these revisions get bigger, and or the company maybe take a bigger restatement, that could be a catalyst as well.
Yeah. Now, what's the story of the board itself? Like, have they done anything that you would say, maybe is a step in the right direction, or what's kind of their role in the overall governance of the company?
Nothing notable of the board. I mean, we obviously do not just background checks on management, but also on the board. I would say it's an average quality board. I mean, obviously we think and we hope that they're, reading our report and, will hold management accountable for any shortfalls in the reporting. But we also obviously hope and would call on them to hire an independent forensic investigator, obviously, to review. Part of our challenge and concern sometimes is that, obviously the board, sometimes the board members may be representing some of the investors, obviously, and they have very little incentive to rock the boat, right? Because their investment could be impaired, and or they hire friends of the board to review our work. We would love to see an totally independent firm come in and review our work and give the board any findings of any malpractice.
Yeah. But in summary, you think this is this company should trade at 5 times revenue or thereabouts, or
yeah,
less?
I mean, look, we think it's at the end of the day, we certainly feel very strongly that in North America, they're having challenges, right? I mean, I think the numbers that we know from 2020, and again, they don't draw your attention to this, but in the annual report, they give their geographic revenue reporting, right? for 2020. And we could look back at 2019. We know they bought SafeCharge, which was all Europe. So we can figure out, that they were declining double digits in 2020 in North America. If they gave better disclosures, they would give you quarterly, right? Quarterly geographic numbers. But we suspect they're probably still on, if they're historically been under pressure in North America, I mean, it's safe to assume they probably still are under pressure in North America. And so that's like a declining portion of their business. And then the European business, again, is very niche focused, a little bit more on, gaming, and the assets again acquired, 5 times. And yeah, I mean, it feels like the right multiple, 5 to 6 times, 7 times at best for a business like this.
You don't see, but just to be clear, you don't see this as an outright like bankruptcy risk. I don't know what their balance sheet looks like, but is there any risk of being a total zero?
Well, I mean, look, they wisely raised capital when it was available to them, at an opportune time at $123 a share, right? In October. And so the balance sheet is good at the moment. They have over 700 million of cash and 500 million of debt. So they have a cash surplus. Now they've earmarked, cash for acquisitions. It doesn't seem likely that they're going to do anything transformational on the acquisition side. They talk about wanting to do, more tuck-in acquisitions that add product solutions to make their overall portfolio of solutions more robust for clients. We will say though that some of the recent acquisitions they've done, in addition, that have been expensive and very speculative. So they bought they bought a Latin American business called Paymentes, which they promoted as high growth, but we did some diligence there. It's been around for over a decade, and in our view, it looks like it's been declining. They've tried to position themselves for the U.S. Sports betting market, which is still very nascent. Hasn't fully developed yet. They made an expensive acquisition there in Mazuma. They also made, they're starting to stake their claim in the crypto space. They bought something. So, they're spending a lot of money in the hopes that these markets ultimately develop. But there's obviously a risk that they don't. And so that's something that could get no return on investment if those markets don't develop the way they hope. But no, I mean, I don't think that there's an imminent bankruptcy risk here. And I mean, unless the financials are totally fabricated, which we don't have any pure evidence of that, but they do have a net cash surplus at the moment. And so, yeah, I think it'd be, and we do think they do generate some cash flow. So we don't see any imminent, bankruptcy risk.
Yeah. I mean, it sounds like the story here is mostly that it's kind of a somewhat niche-y, commoditized player trading at a pretty high multiple without any real like winning horse. I mean, like they've sprinkled cash into a lot of different businesses and in a bunch of niche markets that are kind of high risk, but they don't really have any dominance in any single market. And you combine that with kind of a somewhat sketchy management team. And that seems to be the story here.
Yeah, no, I think that's right. I think, again, this is a another highly promoted Canadian roll-up of company that, is the best in its class of what it does. We don't believe that's the case. It's not clear to us that they do anything differentiated that the next guy doesn't do, although, they claim they kind of bring everything together in one platform, make it easy, but they're not the only game in town. And investors are ascribing a high value to that on the belief that they're going to continue to grow 30% per annum. And maybe they will continue to grow 30% per annum, but we don't believe it's going to have the same effect on the bottom line. As we pointed out, we think they've already tapped out the higher margin, higher risk payment opportunities. And so, we think this company is going to disappoint on the lofty expectations that the sell side has put out to justify these lofty share prices.
Awesome.
Targets.
I think that's a good summary. Ben, thanks for putting this together. I think your timing was obviously pretty amazing. It seems like you're making waves. Looking at the stock price, even yesterday, and thinking, wow, like this Ben just posted this, and it's all over Yahoo Finance.
Yeah. Well, look, the market's the ultimate arbiter, right? And so,
Right.
so somebody out there of some of decent size seemed to take our report at
Yeah.
some strong level of credibility. But it'll be interesting to see where we are a year from
Yeah,
now.
I think a lot of these like mid cap to small cap names, because the sell side will never call them out, and they don't really get much coverage from Wall Street. So
Yeah.
it sort of takes somebody in your shoes who's going to do the work to to call out situations like this. So anyway, we'll certainly keep track of it, and looking forward to the next Spruce Point report.
Well, everyone stay safe, stay healthy. Thanks for following Spruce Point and Some Zero. It's been a great, what started as a very challenging year for short sellers, ultimately ended up being a good one for those with the mettle and fortitude to stick out the rather turbulent environment. But we appreciate everybody following, and we're looking forward to next year with some new ideas. So stay tuned.
All right, thanks, Ben.
Thank you.